Well, for now, the market has lost all of its initial steam. So the Nifty is down about 30 points from the day's highs. 11,383 was actually the highs of the day, and now we're sub 11,350. So market has come off quite a bit. The mid-cap index is now in the red, so down about 25 odd points. A couple of these PSU banks are getting hit quite hard this morning. So Karnataka Bank, you have Punjab National Bank, etc., that are all in the red right now. But in the past few weeks, promoter pledges have been on the rise. So the question we're asking now is, how should investors proceed? We decode this for you with Devin Choksi of KR Choksi Investment Managers. Devin, hi, good morning and thanks for joining us. There are several instances in the past 6 months of promoter pledges being on the rise. The more prominent moves are from the likes of Imami, etc. I want to start by asking you, how big is this promoter pledge mess? And do you think that there should be more disclosures in order to protect investor interest?
Yeah, good morning, Sonia. Well, I think the pledge of shares, I think is not bad, and probably I think it's something which is fundamental rights of anybody to pledge their assets and I think create the borrowings for the use. However, when it comes to listed securities which are listed on the market platform, I think it demands the transparency of the transaction. Currently, what is happening that the promoter and the lender, they meet outside the market platform and create a transaction and then subsequently report as an intimation for the transaction that has been created, which is bad in practice, because on one side you are giving the power to the lender to sell the share in case of I think recovery requirements. On the other side, I think the entire transaction which happens at the first place is not on the market platform. Should this transaction not be on the market platform like how derivative market transactions are in form of open interest? Should these transactions not be on the market platform like how the stock lending and borrowing transactions which remain on the market platform, so that the investor at large I think would get a complete understanding about I think what is the pledge situation on a day-to-day basis, on a minute-to-minute basis in the marketplace. Here the problem happens when I think the lender starts selling their shares on a given day, and at that time I think they enjoy 150 to 200% kind of a margin, so they crash sell the shares and it distorts the price. It affects the confidence of the investor. So this is where I think the bigger problem lies, and that's where the solution is required to be found out. According to me, I think there is a flaw in the system which requires to be corrected. If stock lending and borrowing happens on the market platform, loan against shares must happen on the market platform. If that doesn't happen, it defeats the very basic purpose of the transparency and the credibility of the market for the investors.
No, Devin, selling does happen in the market. And all we get in terms of information is the quarterly information, right? When shareholding pattern is disclosed, at that time, along with it, the promoters disclose what percentage is pledged. That is the only information we have, which is quarterly in terms of pledged. So what you are asking is that we get day-on-day information on pledges, everyday information?
Yes, Lata, I think what I'm saying is that I think there is a need to have this entire system in the marketplace, like how you have an open interest for the derivative market, how you have the open interest for the shares which are lent in the market platform. Similar way, I think you should have the system in which I think you have the open interest given to the market players for the shares which are on the loan against shares kind of a transactions. It means that I think the investor would get a proper understanding about I think the pledge on a day-to-day, minute-to-minute basis, and in a situation when the pledge is disproportionately high, instead of getting it to know from the reporting mechanism, I think they would know it on the market platform itself. So if they want to take care of their investment before the lenders start hammering the stock prices, I think they can get a chance to do that. So in all fairness, that is required in order to protect the system. It also means that I think if the lending and borrowing is a natural activity, if it is happening on the stock, against the fund also if it happens on the market platform, it will solve a larger problem. Because today only few lenders lend I think for this particular transaction. Once it comes on the market platform, even the lenders can distribute the risk. And in a given situation, they do require such kind of mechanism to distribute the risk. So if it is on the market platform, even the lenders can change hands for the credit that they have given to the borrowers, and that is where I think you can probably create a very powerful system. On the other side, the borrowers would get an advantage of the market rate of interest, which in this case I think they are not getting it. So all in all put together, if you look at borrowers, the lenders and the investors, all the stakeholders in place probably I think it demands that the system should be on the market. The entire transaction for loan against shares should happen on the market platform and not outside the market platform.
Okay, so there are some cases like that, right, where there is transparency. Imami, for example, where of course the fundamentals are good, pedigree is strong, but they've also used the right channel and have given proper disclosures when they sold their promoter stake in order to sort of pare down their debt. One shouldn't be concerned with companies like this, right, that use the right channel and use transparent methods to sort of sell their stake?
Well, I think, Sonia, it is you should be lucky enough to, I think, get the buyer for the money that you want to raise. Like how the promoters of Zia currently trying their best, I think, to get the money against their shares. So I think you should be really lucky. But in my viewpoint, I think here the situation is that if the borrowing has taken place for a temporary purpose, should it not be on the market platform? If it happens on the market platform, then probably this entire situation is mitigated by the system itself. That is what my point is. In case of Imami's example that you took, I think probably yes, I think they are lucky enough to, I think, get rid of their pledge and probably, I think, sell off the shares like it has happened for many other companies. So that is something which is very nice to happen, I think, because the investor's interest is protected. But most of the time, I think it is not getting protected. If you see the August to October period of 2018, I think plenty of companies, I think, came down heavily because of, I think, this pledge share related issue and the NBFC selling those shares. Recently in January, I think you saw this particular situation happening for likes of Net and others. So this is where the problem lies.
Devin, what do you mean by it should happen in the market platform? A promoter will go to a specific broker or NBFC to pledge shares, right? What do you mean by market platform? I didn't get you.
So Lata, I think yes, I think it's good to explore this particular, I think, even on the screen as well. On one side, I think there is a lender who is registered on the market platform, like suppose, say, for example, NBFC, or say, for example, any other fund, I think, who wants to lend, they are registered on the market platform. Like in a normal category investors, I think they are registered on the market platform. On the other side, I think the borrower, in this case promoter, comes to the market, I think, as a client, and he borrows this share under this particular segment. So you typically create a segment here, which is a loan against share segment. Like you have stock lending and borrowing segment, you create a loan against share segment on the market platform, wherein I think the two entities meet each other.
Okay, we'll have to wait and see. You know, there'll be a lot of reform needed, and promoters and SEBI will have to be on the same page. Just leave us with some advice. I mean, there are a whole host of promoters who have pledged, you know, some of them even 100% of their shares, like, you know, CG Power. The list has been running. Some of the Jindal companies, GMR, Max Financial, Coffee Day, Parsonath. The list of highly pledged promoters is there. Help our investors understand which of them you will keep the faith. You know, when a promoter has pledged, technically speaking, you know, if he doesn't win back the pledge, what is his ownership right on the company itself? It becomes a little suspect whether he is still loyal to the company. So how should an investor approach the entire set of promoters who have pledged their shares? Which should they buy? Where should they keep the faith?
See, I think it's a very pertinent question, Lata, and I think under the current provision of law, I think there is nothing which suggests that the promoter has to take the permission of the co-investors while, I think, pledging their shares in X quantity. Suppose if, I think, they have 100% of their quantity pledged, should there not be a permission taken from co-investors on this particular side? I think that is a fundamental question. Currently, under the law, that provision is not available. And I guess, I think, the regulatory authority will have to enforce this kind of a provision to begin with. The second most important aspect here in this case is that what an investor should do in this case. Before an investor do something else, I think the promoter should be asked to, I think, explain what kind of pledge they have created and by what time, I think, they are going to unpledge this particular thing. That commitment should go onto the stock exchange platform as a reporting mechanism directly. If that communication is also not happening, an individual investor cannot reach out to promoter and get explanation for every transaction he has done, because it is not under the provision of law for him to report that particular transaction to the stock exchange or the regulatory authorities. So first make the rule right and then probably ask investors to refer to the promoters for the transactions.
Fair enough. So we have to wind down because we are time out on Bazaar. Thank you very much, Devin, for joining us. And as we wind down on Bazaar, there's a little more red on the screen. So you're going to get long and short ideas on Chartbusters. Thank you very much for watching Bazaar.